Hi there. Welcome to The Open here on BNN Bloomberg. I'm Lindsay Biscaya in for Andrew Bell this week. So let's get to some of the stories we're following in the BNN Bloomberg newsroom this morning. MasterCard is buying stablecoin payments infrastructure firm BVNK for up to $1.8 billion US. The London-based platform enables sending and receiving payments on blockchain networks across more than 130 countries. MasterCard says it expects most financial institutions will eventually provide digital currency services. The transaction is expected to close before the end of this year. NVIDIA CEO Jensen Huang is predicting the company's AI processors will help generate $1 trillion US in sales through 2027. Huang was speaking at NVIDIA's biggest annual event, where he also unveiled a variety of new products. He announced plans to push deeper into central processing units, and he also introduced new semiconductors and NVIDIA's plan to develop chips for data centers in outer space. And oil prices have rebounded after the first drop in almost a week. Earlier today, a large gas field in the United Arab Emirates was targeted and a vital oil port was halted. These incidents add to a fast-growing list of energy assets across the Middle East that are being targeted by Iran. Meanwhile, U.S. National Economic Council Director Kevin Hassett says more oil reserves could be released if needed. And we'll take a look at the U.S. futures to start your morning, all trading up at the moment, but, just by Dow, at least the Dow future up by 0.3%. The NASDAQ is up by 0.1%. So not a substantial gain compared to yesterday. And we take a quick look at the TSX as well here. It was trading higher yesterday, probably continuing that trend again today after seeing some losses last week. We'll obviously be keeping an eye on that throughout the morning. At its GTC conference, NVIDIA's CEO announced its flagship AI processors would help generate $1 trillion in revenue by 2027. But while the $1 trillion projection gave a flashy headline, our next guest says when you break this number down, it doesn't show much of an acceleration from the company's previous forecast. So joining us now is Nicholas Mersch, portfolio manager at Purpose Investments, to dive into this. It's good to have you join us. Good morning.
Thanks so much for having me.
So you say AI trade is maturing from hype to return on AI. Do you think this $1 trillion is enough of a return to get investors excited?
Yeah, that's right. And I think this trade overall is really, people are starting to question, when can we convert this AI CapEx into much more durable revenue, margin, and cash flow? And that's why I think the Mag 7 have been under significant pressure here. And they just entered a 10% correction over the overall basket yesterday, because the market is starting to bet on those who are collecting the checks instead of those that are writing the checks. And a narrative early on in this was that all this is free cash flow funded. But we're now seeing two things happened. So the first is that free cash flow is starting to decline. And the second is there an increasing amount of debt being issued by the mega cap companies. At the same time, we have private credit starting to show a lot of cracks in the overall ecosystem, and then spreads widening in the fixed income market as well. So the key here to watch is just how quickly AI is monetized and how much of this spending will convert into long-term durable moats. I think Amazon and Microsoft are positioned well, and Google actually positioned the best here for capturing longer term upside. Now, when it gets to that $1 trillion NVIDIA number, the headline is one of these flashy numbers, and a lot of the analysts are going to spend a lot of time very digging through this number and saying, what exactly does he mean by this? But the previous forecast was $500 billion by the end of 2026. This new forecast is $1 trillion by the end of 2027. So what we saw here was really this cumulative number was pretty close to in line with consensus, because when you strip out the same time periods, consensus was already sitting at $1 trillion over this time frame. So people were really looking for an incremental boost. But what we really have to see here is what else will be added on top of that, because NVIDIA is not only selling a chip now, they're selling an entire data center, an entire unit of compute. So I think there's going to be a lot of room for upside when it does come to around some of the other numbers and some of the other business lines that they sell connected to the chip just itself. So that could give some upside onto the EPS. But look, analysts are going to comb through these numbers, see what they mean, see what business lines they're specifically talking about. But either way, this is impressive growth at impressive scale. But the market's starting to expect some of these numbers, and we're no longer seeing these massive beats and these massive price moves, as NVIDIA is really just running up against the law of large numbers here.
And you compared NVIDIA just a couple minutes ago to like Meta, to a couple of other of the big hyperscalers that you think are positioned well. Do you think NVIDIA is positioned well within its big competition?
Yeah, absolutely. And what they're really doing here through this next iteration and these next sort of GPU units is stacking a lot of these S curves. So S curves in technology, you sort of see this rapid growth and then a little bit of a plateau. And then you see these periods where you have to introduce new technology to keep pushing the envelope forward. And what we saw throughout GTC here is another step function forward, because their compute capabilities have increased 35 times from the last series. So when you're seeing all these hyperscalers, these are the companies that are writing the checks and essentially paying for the GPUs that NVIDIA is providing. But what we're starting to see here is, again, they're running up into how are you going to start funding these things, because the free cash flow from these hyperscalers is now starting to decline. The cash balances are starting to decline. They're starting to issue more debt. So it's where does that next level of growth come from? Now, what I do want to pay attention to, and what people really go through and comb a lot of these different remarks from Jensen is what other components in the ecosystem are benefiting. So he made a lot of comments around whether copper or optics are going to be the scale up and scale out units. So you're seeing different components of the supply chain start to move. And NVIDIA is a little bit of a kingmaker here, because you can see some of these memory companies, some of these storage companies like SanDisk, like Micron, like Western Digital. These stocks are up massive because you need a lot more storage and a lot more compute to power the compute as well. So we're seeing NVIDIA really become a kingmaker among different components of the overall ecosystem as we have these rotating bottlenecks. But look, even though NVIDIA could be running up against some large numbers here, they're still the king in the area. So I still like the name a lot.
And as you mentioned too, just before we move on from NVIDIA, like all these new partnerships and NVIDIA announcing autonomous vehicle partnerships with both Lyft and Uber. Does this benefit NVIDIA, yes, or is this, obviously we're seeing Lyft and Uber already, the share price benefiting from this partnership?
Yeah, and I think when you go out and you have some of these companies announcing these partnerships, you get a lot of these stock movements. We saw it early on with the OpenAI complex. As soon as they kind of announced partnerships with these different companies, the stocks would just kind of rocket on those single days, which are a little bit reactionary and knee-jerk. But some of these partnerships can really endure very long-lasting sort of competitive advantages. On the autonomous vehicle front, it's particularly interesting because what you see here is a lot of these companies are trying to figure out where they fit in the distribution of the platform. So you have kind of Uber and Lyft saying, look, our number one costs here are our labor for our drivers. If you can get rid of that cost, you can drive down the dollar per mile when it comes to the transport side of it. So you're seeing a lot of these capabilities and these technologies being introduced that are very accretive when it comes for the margin profile of these other platforms. Now people are saying, hey, look, Tesla could come out and put together their autonomous fleet, and they've already got so much data that they're collecting because they have so many cars on the road right now that are essentially a big data ingestion engine that are powering these AI models behind it. So really interesting stuff in the autonomous vehicles front as well. And NVIDIA, again, is going to be powering a lot of this forward because you need that hardware. You need the more compute for it. And NVIDIA still pushing the envelope here forward.
And just before we wrap up, obviously, I want to get your thoughts on the software sector as well, right? If we're talking tech and AI, obviously, you can't really talk about that without talking about the software sector. We saw it take such a hit at the beginning of this year. Do you think it's rebounding, or what do you think the future is for software? Are there just some companies that might make it out of this and some that won't?
Yeah, so I think that the taglines here were the SaaS apocalypse and the SaaSacre in terms of the acronyms that people were going through. And software is still going through this messy repricing right now, and I don't think this is going to be over quickly, and there's no silver bullet. Agentic AI really threatens that seat-based SaaS models by shifting a lot of the value towards outcomes while also creating margin pressure through self-cannibalization of higher inference costs. And so by that, what I mean is a lot of these different companies are coming in and saying, hey, look, I can produce software now with a marginal cost near zero. And what happens is distribution becomes very important. Being a system of record is as important as some of these companies are saying. So software, I think, is going to have a really messy time here in terms of figuring out where the silver bullet is. Now, that being said, I think that everything getting thrown out and everything getting sold off here is a little bit of a drastic knee-jerk reaction, and there will be still some winners in the space. But right now, look, there's easier money to be made in other places. I would still keep that in the too hard bucket right now. Focus on the physical economy, because this is metered intelligence that is consumed rather than build once and sell it forever like software. Focus on the physical economy here. Look at the hardware components and look at the materials as well.
Okay, we will leave it there. Nicholas Mersch, portfolio manager at Purpose Investments. Always good to get your insight. Thanks so much for joining us.
Thanks so much for having me.
Coming up, Finland's president says NATO allies have to take President Donald Trump at his word when it comes to trying to secure the Strait of Hormuz. We've got more on that right after the break. Finland's president, Alexander Stubb, says NATO allies have to take President Donald Trump at his word when it comes to trying to secure the Strait of Hormuz. And he says that, quote, we obviously have to take everything that the president of the United States says seriously. Earlier, we got perspective from Finland's president in a Bloomberg interview. Take a listen.
First of all, I think we now need to de-escalate rather than escalate. So what we probably need is peace mediation. The actual original operation was not discussed with allies, but I'm sure that President Trump is now in conversation with the UK, with France, Germany, the big players.
I think President Trump said that NATO faces a very bad future if U.S. allies fail to assist. How should we take that?
Well, I think, we obviously have to take everything that the President of the United States says seriously. I think the key now is to focus on the alliance and what we do. We are a defensive alliance, which means that we don't do military attacks as such. We're 32 countries. Of course, after the Cold War, we had some peacekeeping missions, but they were always justified through international law and UN charters. So this is quite different from that.
Do you think the U.S. should be helped?
I think those countries that have the capacity and the will to help the United States will do that and should do that. We have to understand that the situation, of course, in the Middle East and in the Gulf region right now is extremely serious. We have Iran that has attacked somewhere between 10 to 13 different countries with missiles and drones, and that's why I think any de-escalatory measure right now would be very useful. Iran's interest, though, the problem here is that Iran seems to have three interests. One is to cause damage to its neighbors. Two is to maximize the harm on the global economy through the oil price. And the third one is to keep up their current regime.
But how does this de-escalate? First of all, who are the right people or the right person to try and help?
Well, we need a ceasefire. So I'm just wondering whether the Europeans or actually India could get involved. We saw Foreign Minister Jaishankar calling for a ceasefire and negotiations just to calm down the temperature and freeze the situation as it is. The problem in these kinds of situations is when you kind of have three players, Israel, the US, and Iran, all with more or less different interests. It's very difficult for them to organize themselves into a peace kind of a situation.
Do you have a clear understanding of what the US is trying to achieve?
I think the original aim, and obviously I don't want to give advice to the U.S. administration, but from what I understand, number one was to shut down the Iranian nuclear program. Number two was to damage their capability in terms of missiles and both launching and defense. Number three were the proxies, so terrorist organizations such as Hamas, Hezbollah, and the Houthis. And number four was regime change. And then, of course, you're going to have to ask the American administration which one of this is more important, which one is going to materialize.
President Stubb, the EU High Representative Kaja Kallas was talking about repurposing the EU's Red Sea naval mission to the Strait of Hormuz. Is this a good idea?
Well, I haven't seen the latest reports on the EU foreign ministers meeting. But that could be one way of helping out. But that is for the EU foreign ministers to decide. And I think they're still sitting as we are having this conversation. So I don't know the outcome.
And I understand you're calling for de-escalation, but how worried are you that this actually escalates, that the conflict widens?
I'm worried because what we used to see, especially after the Cold War, were local conflicts, almost like wars of civil wars. Now we're seeing regional. I mean, first we saw Israel, Palestine, then we've seen Russia, Ukraine, and now, of course, we see Iran and 10 to 13 countries. So, of course, I'm worried. And, to all of my European friends or American friends, I sort of asked the question that how would we feel if there were missiles flying in our region to 13 different countries? Of course, we would be extremely worried. And that is the mindset that I think a lot of the countries in the Gulf region and in the Middle East have, because they didn't want this war. And that's the problem. That's why I think we need to bring down the temperature. The United States military has shown its might. There's no question about that. They've hit X amount of targets quite successfully, but now it's time to please calm down.
There are also media reports that actually Russia was reportedly sharing intelligence with Iran on the location of U.S. forces. Yeah. Is that true?
Well, it's super worrying, yes. I mean, I wouldn't put it past them. And this is what I try to tell my American friends as well, that, there are two elements of this. One is that Russia is now giving shaheeds back to Iran, which they can hit American bases. And two, they're giving intelligence about where the American bases are. So basically giving the executive order to kill American soldiers. And I'd be very worried about that. But of course, as a Finn, I'm more worried about the repercussions on the war in Ukraine, because that's in many ways, our war, which we feel very strongly about. And we're seeing now increased oil prices, which basically feed the Russian war machinery. We're seeing the United States lifting sanctions on Russian oil. We're seeing the U.S. giving a waiver to India for buying Russian oil. So everything is linked to everything. And we now need to get back to focus also on Ukraine. That's why we need a ceasefire in Iran.
But is this good or bad news for Ukraine? So if Russia is implicated actually in the war in the Middle East, does it make it more likely that they can't share intelligence with Iran or can't get missiles actually when it comes to Ukraine?
Well, if this was a binary, choice between good and bad, I'd say it's bad because of the oil price. In other words, for Ukraine. But the situation actually on the military front for Ukraine is good. They're actually getting back more territory than what Russia is getting. And obviously, the lethality of the Ukrainian war machinery and defense forces is very strong, because in the past 3 months, there have been over 90,000 dead Russian soldiers, with much, 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 much less on the Ukrainian side. So from a military perspective, I'm not too worried right now, but from a financial perspective, in other words, feeding the Russian war machinery, I am worried.
What do you say to people who say, well, if the U.S. can act this way in Venezuela and Iran, then actually Russia can act this way in Ukraine?
I think a lot of countries are now working outside the framework of international law. And that's why I have called, for a revamping of the world order, a return back to international institutions, norms and laws. But in order for that to happen, you need a consensus among the 200 nation states of the world. And I have always believed that, in the future it should be the likes of India and others that have a bigger say in this. But right now we're seeing what, a Hobbesian world means, a world where power vacuums emerge and then someone feeds them. For me, diplomacy is always about win-win, and right now we're seeing zero-sum, a lot of transactions and deals, and it doesn't seem to be working.
Up next, we will go through some notable calls. That's coming up right after the break. Stay with us. Welcome back. Let's take a look at some of the notable analyst calls and recommendations. Our first notable call is for two U.S. energy names. That's Diamondback Energy and Devon Energy. They were both named top picks at Mizuho Securities. Analyst Nitin Kumar says 2026 oil prices will be higher than expected due to the Iran war, and U.S. natural gas demand remains strong. Diamondback Energy was kept at an outperform rating, but the price target got a boost to $220. That's up from $205. And Devon Energy was also kept at an outperform, but the price target was raised to $62, up from $51. The analyst says Devon's merger with Coterra will make it one of the largest U.S. shale companies by volume and will offer large tier 1 shale inventory. And HSBC is turning bearish on obesity market growth. The firm cut the drug maker Eli Lilly to reduce, that's its loan cell equivalent rating, from a hold, saying expectations for the total addressable obesity market are due for a correction. The analyst tells investors that while the execution at Lilly has been good so far, we think the risk of paying up for its bullish worldview embedded in the guidance is unattractive, and the company might be set to disappoint expectations. HSBC also says that we think that Novo will fight back for market share and price competition is likely to intensify, leading to a smaller team compared to consensus expectations. Dollar Tree's price target has been lowered at Truist, meanwhile, to $142 from $156. But Truist is keeping a buy rating on the shares, saying it expects trends will continue to improve as it enhances its store standards. And we'll take a quick look at the U.S. futures and the markets just as a whole before the opening bell this morning. We'll start with the U.S. futures, all trading up at the moment, not as much as yesterday, but the Dow future and the NASDAQ up by 0.5%. Same with the S&P 500. It seems as though U.S. stock futures edging higher as oil trims its advantages, and we'll go through that in just a moment. We'll take a look at the price of gold as well, though. It is steadying today, so far at least, as traders weigh some inflation. That's a day ahead, of course, of some key central bank rate decisions. The Bank of Canada, the Federal Reserve, making their latest announcement tomorrow. So we're seeing the price of gold up at the moment by 0.3%. If we take a look at the price of oil this morning, it was at least rebounding after its first drop in almost a week. Yeah, it's up by more than a percentage point at the moment. This all comes as Iran continues to target energy infrastructure in the Middle East. So we're watching today the Shah gas field in the United Arab Emirates has been targeted, and the oil field in Iraq. And we'll also just take a quick look at Bitcoin, seeing a 6-week high yesterday as investors pour into ETFs. Today, trading down at the moment by 0.6%. And stay with us. The opening bells are next. And here are the opening bells at the NASDAQ. Merlin is ringing the opening bell this morning. At the New York Stock Exchange, TC Energy rings the opening bell. And at the TSX, Canara Biotech is celebrating the company's graduation to the TSX. It's time now for the first 15. This is BNN Bloomberg. Trading day is just getting underway this morning, so we're going to check in on the equity market. We'll take a look at, as you can see, the TSX is up by 0.6% at the moment. It seems as though investors a little more optimistic today, also after yesterday. The S&P 500 and the NASDAQ both trading up ever so slightly to start the morning. We'll, of course, keep our eye on that throughout the day. If we take a look at some of the key companies, particularly on the TSX that we're watching, Altus Group is one. It's down at the moment. It finished up yesterday, though, after announcing a share buyback program this week. And we know the company is on pace for its largest percent increase of shares since August 2023. It finished at the top of the TSX yesterday, again, trading down ever so slightly at the moment. We're also watching shares of Nutrien today. It's on pace, on the flip side, for the largest percent decrease since April, finishing at the bottom of the TSX yesterday. And this comes after a warning from Scotiabank that fertilizer stocks could be overvalued, particularly if you factor in what's happening in the Middle East. It's driving the price of fertilizer up. We're also watching BMO today. A big announcement from the Bank of Montreal saying it will open more than 130 financial centers in California, as well as more than a dozen in Arizona. Currently, stock price up by 0.8%, but obviously we'll watch that throughout the day to see if it moves higher. And for movers south of the border, we are now joined by Bloomberg's Janine Panzer to break some stuff down for us. Janine, it's good to have you. So we'll start with Janus Henderson. What's the latest on Victory Capital's revised bid for this company?
Hi, Lindsay. Yes, so Victory Capital is actually coming back with more cash. That's why Janus Henderson shares are up this morning in the green. So what's new here in the revised bid? Victory Capital is saying that the new bid will value Janus Henderson at about 56.84 per share. It is a cash and stock still, but the cash portion is now 40 a share, up from 30 a share in the February proposal. The February bid actually valued the company a little closer to, 57 a share, so a bit higher than this one. But again, today we have more cash up front, so investors are liking more of that component. So we see how shares are reacting to it. Interestingly, with Janus Henderson, it's not just Victory who's after it. It's Trian is also offered to buy it in December too. So we'll keep a close eye and see that this might not be the last move that we see here.
You're also watching shares of Delta Air today, a little more upbeat today after the first quarter amid some March bookings. So obviously busy time of year for many airlines. What's happening with Delta?
Exactly, it's a busy time of year. So Delta shares are actually in the green this morning. The company is optimistic about its first quarter revenue, seeing high single-digit growth for the 1Q. This is up from its previous guidance of 5 to 7%. And what's driving is what you exactly mentioned, is the strong bookings. Airline says that it's seeing surging demand for both leisure and corporate travelers. That strength is coming even as airlines face higher fuel costs during this tension that we're seeing in the Middle East. So overall, it's a sign that travel demand is still holding up.
And lastly, Lemonade, which is an AI-driven insurance company. What's driving that stock higher this morning? I believe it's up quite a bit to start the morning.
Yes, this has been in the green this morning after Morgan Stanley upgraded its stocks to overweight from equal weight. It's a relatively young digital insurer, and the bank says that it could be an early winner as autonomous vehicles begin to reshape the insurance space. It points to the company partnership with Tesla. This is like a first step that it gives Lemonade first mover advantage in this space in data analysis and on-the-ground experience. So Morgan Stanley also raised its price targets to 85, so implying about 47% upside from the last close. This speaks to a broader theme of tech starting to disrupt traditional insurance.
Okay, we will leave it there. That is Bloomberg's Janine Panzer joining us live. Janine, thanks for that. Coming up, we'll have more on the markets and a bullish view on the tech sector. Stay with us. North American markets are edging higher this morning. Oil is also pushing higher after new attacks on energy infrastructure in the Middle East, including an oil field and a gas field. Meanwhile, shipping traffic in the Strait of Hormuz remains largely stalled. So let's find out how that's affecting the markets. Joining me this morning is Michelle Connell, president and owner of Porsche Capital Management. It's good to have you join us. Thanks so much.
Thanks for having me, Lindsay.
It's hard to kind of track this. Like, what's your take on the direction of the markets this morning, really?
I think we're going to continue to have volatility until this situation has some sort of resolution. But I'm not overly concerned unless oil continues to go up. Where we are now, the odds of us having a recession, pretty low here.
Seems as though oil seems to be tracking up, though. I mean, do you expect the price of oil to keep going up? Obviously, it depends what exactly is happening in the Middle East and particularly how much is getting through that Strait of Hormuz. But it doesn't seem to be slowing.
It doesn't, but oil is up about 50% since this conflict started at the end of February. And if you go back in history, oil would have to go up to almost 100% from the beginning of a conflict to a certain point, end point, to have a recession or to have a lot of economic softness. So yes, I'm watching it very closely. It doesn't affect North America as much as it affects Asia. 90% of the oil and the natural gas that Asia uses comes through the Strait of Hormuz.
Yeah, so let's talk about that, the oil supply situation right now. How critical is it, I guess, do you think, at this moment?
I think it's critical, especially to the emerging markets and to a lesser effect, Europe. But for the United States and Canada, we're fine. But that doesn't mean that oil prices won't continue to go, gasoline prices won't continue to go up for consumers. Jet fuel is going up, and it's going to affect our pocketbooks. Before this began, your economy in Canada was soft and inflation was starting to come down. In the United States, our economy was a little bit healthier, but same, inflation was coming down. But obviously, energy prices are going to have a huge impact on a consumer's pocket.
You kind of touched on this, but is there a timeline really in terms of when, if all this stopped, when markets could kind of recover and go back to where they were before this conflict began?
We've become so almost immune, or we don't feel as much as investors when there are big issues. Look what's happened in the past with other conflicts, whether it was Venezuela or Ukraine, or even when the tariffs were announced, the bounce backs were pretty fast. But that being said, this conflict needs to be resolved in the next 4 to 6 weeks, or it's going to really start to impact Asia and the parts of the world that we in the more developed parts of the world depend on them in terms of things like especially hardware and semiconductors. If they don't have the energy, then it's going to be really difficult to continue to have the output for semiconductors that fuel the AI boom.
It's so interesting to see the trickle-down effect, right? Because I was going to switch gears and start talking a little bit more about the tech sector, but it's interesting how this conflict in the Middle East really trickles down into other sectors. As you mentioned, semiconductors, that leads into the tech sector, right? So, what are your thoughts on that sector and the outlook, I guess, for it right now?
Well, that being said, I'm always optimistic on technology because it grows faster in terms of demand than the underlying GDP for economies, because you have to have that build out to continue to have productivity, which helps your economy. So it's interesting, in the beginning of the year, tech started selling off because of the valuations, and NASDAQ is still down 4% year to date. But since the conflict, it's almost like we've gone 180 degrees as investors, and we're seeing the fact that technology stocks are the ones that are growing faster than the underlying economy. They've become cheaper in terms of price to equity and price to growth versus things like consumer staple stocks and industrials, which have become more expensive on a growth basis. So more emphasis on the tech in the long run, because those names have more stability.
Okay, so obviously you like the tech sector, but there are a couple of companies and stocks that you would advise investors, correct me if I'm wrong, to stay away from right now. That's Walmart and Pepsi. We'll start with Walmart. Why is that?
They're trading at a PE, or price to earnings ratio, of almost 45 times. And that's really expensive. And don't get me wrong, Walmart is great, and they've been really good in terms of upgrading their supply chain and implementing artificial intelligence. But it's really expensive here when you look at that PE of about 45 times and the underlying growth rate of about 8 to 11 times in the next few years. So a little bit expensive here. Again, great company. I just don't think it's a good investment here.
And what about Pepsi?
Same thing. They're not quite as expensive. Their PE is probably in the 25 times range, but their growth rate is even lower than Walmart. So as an investor, I'd start looking at things that are cheaper, especially for over the next few years. Look at their growth rates and obviously look at their cash flow, that it's positive. And there are a lot of opportunities out there.
Are there any other opportunities, say, in the precious metals? Like, what are your thoughts on gold right now? I know a lot of investors look at that as like a safe haven.
I look at commodities in general as a safe haven. Would I be, when you just look at the chart, right? I mean, it's done so well over the last year. If you don't have a position, I would be averaging in. I think portfolios in general need to have commodities of 5 to 10%, because those are the things that hold up when you have the conflict that we've had and the volatility. So yes, I think it has a place, and I'm going to be writing about gold today, but again, averaging, because it is very expensive.
Okay, we'll leave it there. Michelle Connell, president and owner of Portia Capital Management. Appreciate your time. Thanks so much.
Thank you, Lindsay.
Just ahead, we will turn our focus to real estate after the average price of a home in Canada fell 0.6% in February. It's continuing a string of declines that we've been seeing. More on that coming up. Canadian home prices dropped in February as lingering economic uncertainty forced sellers to offer bigger discounts to reluctant buyers. For more, we are joined by CTV's Annie Bergeron-Oliver this morning. Good morning, Annie. So, new monthly home sales statistics by the Canadian Real Estate Association out this morning. What are these figures actually showing Canadians in terms of the market?
Hi, Lindsay. Well, what this new report from the Canadian Real Estate Association is showing is that home prices are falling, there are fewer listings, and overall that the market is fairly sluggish. Now, they do say that some markets are still fairly hot, but there are also markets where prices are moderating and coming down, like Alberta, for example. So let's look at the actual sheer number. So nationwide sales are down 1.3% from January to February. New listings down 3.9% in that same period of time. Month to month, if you look at February 2025 to February 2026, sales are down 8%. The other interesting statistic here is the fact that the benchmark home price is down 4.8% to $661,000. So again, overall, what this is just picturing is another month that's fairly slow for the real estate market across Canada. Prices are low. People are sitting on the sidelines waiting to wonder whether this is the time to be jumping into the market. But the Real Estate Association does say that it expects to see some pickup in the spring. So April and May, they're expecting to be a little bit busier as more homes get put on the market and more first-time buyers specifically decide to jump into the market finally.
So interesting. And it's early days, obviously, but is this conflict that we're seeing in Iran, in the Middle East, having any impact on home sales and affordability for buyers here in Canada?
Well, the report doesn't get into that at all, but what economists are saying overall about this war, even though it's still early, is that it is impacting consumer confidence in a range of areas. It's also increasing gas prices, and economists are saying that that has the potential on its own to increase inflation, which of course will impact the buying power of consumers. What the Real Estate Association has said in its previous reports is that one of the reasons housing prices are coming down is because interest rates have been high. Right now, a fixed rate mortgage around 4%. So it's lower than it has been over the last few months, but it's still higher than it has been over the last few years. So interest rates were one reason people weren't getting in. Another factor was economic uncertainty, and the war definitely plays into that. We're seeing high unemployment, weaker job numbers, consumer confidence overall isn't there. And so the Real Estate Association has said that a lot of first-time buyers specifically haven't been getting into the market because maybe they don't have the savings or they don't have the confidence that right now is a good time to get into the market. The Real Estate Association is saying that it hopes that this spring will kind of be the time that a lot of first-time home buyers finally decide to get into the market, saying, you know, maybe prices have stabilized enough that now is the time to do it. They're also saying that a lot of people have been sitting on their homes, and so they do expect inventory to increase in the spring, and that can also help bring down the cost of homes as well, Lindsay.
Okay, we'll leave it there. That's Annie Bergeron-Oliver from CTV News joining us live. Annie, thanks for that.
Thank you.
Coming up after the break, we will hear why well-known fund manager Cathie Wood says AI is delivering astonishing results and is largely beating Wall Street's expectations. That's next. ARK Invest CEO Cathie Wood says the impact of artificial intelligence-driven productivity gains on the global economy is astonishing, and it is set to create trillions in new wealth. Earlier, we got perspective from the well-known fund manager in a Bloomberg interview with Anna Edwards. Take a listen.
We are seeing revenue generation exploding from the frontier model providers. Anthropic's annualized revenue run rate, so ARR, went from $9 billion in December to $19 billion today. So annualizing revenue at $19 billion, that's astonishing growth. OpenAI from 20 to 25 billion. The productivity that we are enjoying from these large language models is astonishing, even within our own firm. I'm even former skeptics that this was going to amount to very much, very New York skepticism. They're blown away by what they can do.
Do you find that already? Do you think productivity is delivering already? I mean, within your business, but for the US, for the global economy, is it already the case?
Yes, actually, on a year-over-year basis, non-farm productivity is up 2.8%, which is above trend, and we think it's going much higher, maybe 4, 5, 6%, based on these new productivity tools. And it's not just AI; it's the convergence of AI with many other technologies, that autonomous mobility. So if we're talking about robotaxis, the productivity, the unlock there is huge. We're going to see 10 to 12 trillion in revenue generation within the next 5 to 10 years from almost nothing now. That is going to be a needle mover in terms of GDP.
Okay, we'll come back to the technology themes in a moment, Cathie. Just to take a detour to geopolitics, because it's become such a dominant market driver, and I wonder how it influences your thinking. We are week 3 of a war that's taking place in the Middle East. Many tech businesses, of course, probably quite insulated from everything that is happening there. But I wonder, what rethinking does it prompt at ARK? What shift in focus or shift in strategy, if any, does this kind of thing prompt?
Yes. Well, of course, it depends how long-term this is. And we are thinking it will be short-term. We do have midterm elections this year and other considerations. But, of course, energy prices going up, any supply shock, to the extent it slows unit growth down, it will slow down the learning curves associated with various technologies. If this is, a month or 2 months, it's not going to have a big impact at all. If this is extended, COVID, we did not understand that the supply shock would reverberate for 3 years, and that inflation would take off, and that monetary policy would accommodate the inflation the way it did. We're not in that situation right now. Monetary policy is not accommodating inflation. We're at 4.3% M2 growth on a year-over-year basis, so nothing like the high 20s, low 30s in COVID.
Okay, and do you sense that investors are maybe less interested in technology, trying to make space in their portfolios for other themes around geopolitics, around defense, around infrastructure? Is that something that is causing outflows at ARK and other technology investments? Yeah,
it's interesting. In the U.S. and here, UK, Europe, we've had inflows into our ETFs. Not huge, but there's been a turn. And so I think many people are beginning to think that this is just like April of last year. And I was here in London saying, we're in a bull market and we're climbing a wall of worry. And the tariffs put in a few bricks. The government shut down. Now the Iran war. So they seem to be using this opportunity, this setback, to buy into some of these technology-oriented themes.
Okay. And do you think then that, pre the Iran war, big tech was already undergoing showing something of a rotation away from some of the software names and funding the software names much more towards hardware, and that was benefiting Asian tech. How are you thinking about US versus Asia tech at this point?
Well, we think that the two biggest competitors, of course, are the U.S. and China, and we actually are impressed by some of the open source models coming out of China, DeepSeek and Qwen and others, and they're open weight, so our models can distill from them when they're clever, and vice versa. So it's very interesting on the software side, as opposed to the hardware side. Our government is not saying a thing about this kind of exchange. In terms of SaaScopolis, which is what you're talking about, you could see that coming. In our Big Ideas 2025, we broke this tech stack into three parts: infrastructure, so data centers, chips; platform as a service, poster child there is Palantir; and then applications, much of which was SaaS. And we saw that the incremental growth in technology over a 5-year period was moving much more towards platform and infrastructure than it was to applications. Yeah. And that was our first clue that platform as a service was going to customize software and take share from SaaS, which is one size fits all.
How far through that SaaS apocalypse do you think we are, Kathy?
Well, I think in terms of the stocks, we've discounted a lot. And my experience with disruption, and SaaS is being disrupted, make no doubt about it, is that at some point they become value stocks. And value managers start looking at the cash flow characteristics and the stickiness of some of these software products, and they venture in and really take over from growth managers.
That was ARK Invest CEO and CIO Kathy Wood. Just ahead, we will check in on the markets and get some ideas for your portfolio right after this. Stay with us. Hi there. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following for you in the BNN Bloomberg newsroom. Shares of Delta Airlines are up today. The American company is issuing a more optimistic sales target for the first quarter despite rising oil prices. The upbeat outlook is attributed to accelerated bookings by leisure and corporate customers in March. The airlines company says corporate demand will likely stay strong if prices remain elevated during the next 2 months. Delta's earnings will remain within the initial guidance. And Canadian mortgage billionaire Stephen Smith is buying a minority stake in the Economist Group. Smith and his family's holding company, Smith Financial, will buy the entire 26.9% stake from private investment company Rothschild. The price of the transaction has not been disclosed, but the deal is Smith's first foray into media. And Canadian home prices dropped in February, continuing a string of declines. The Canadian Real Estate Association says the benchmark price of a home fell 0.6% from last month. Canadians seem to be cautious because of economic uncertainty caused by the ongoing trade war with the U.S. and the war in Iran. And we'll take a quick look at the markets this morning. The TSX trading up by more than a full percentage point at the moment after trending higher yesterday too. Similar story south of the border as well as we look at the U.S. markets. Up, S&P 500 up by 0.6%, the Dow Jones up by 0.7%, same with the NASDAQ composite. It appears investors a little more optimistic as we see the price of oil also trend up today. And as we just saw, we're seeing stocks advance as investors appear to be setting aside some of their worries about the war in Iran, and oil prices appear to be moderating. Let's get perspective now from David Dietz, Chief Investment Strategist at Dietz Wealth Management Group. It's good to have you join us. Thanks so much.
Thank you. It's a pleasure to be with you this morning.
What are your thoughts of what we're seeing so far, at least this morning, in terms of the direction of the markets?
Well, so it seems to me that markets are really taking heart with the fact that we've had some key players in the economy suggest that they're really not worried about the Iran situation, notwithstanding the kind of the standoff over the Strait of Hormuz and the geopolitical risks. We heard, for example, from Delta. Now, you would think an airline would be the most impacted from the crisis going on there. People would be worried about terrorism, worried about getting onto an aircraft, worrying about the surging prices of oil, which is pushing ticket prices up. And what does Delta come out and say? They say they're just seeing some of the 8 out of the 10 best days ever in the history of their company in the last couple of weeks here. They're raising their forecast. And so I think that's giving confidence to Wall Street and investors that, in fact, although it's a horrific situation over there, the average American consumer, which of course is the strength behind the U.S. economy, is still going full bore ahead with their spending plans and not changing anything.
It's interesting. So then do you think we're seeing resilience, or are we just going to be seeing more volatility, taking your point of what you just said?
Well, we're definitely seeing resilience here. I mean, notwithstanding everything that's going on here, the S&P 500 is only down about 4 or 5%. I think one of the reasons there, of course, is that in some ways, the United States benefits from the higher energy prices because it is a net energy exporter. There are, of course, transfers between one area of the economy to the other. But, of course, we are going to see volatility. There is no end game now in sight in the Iran war. President Trump has tried to develop a coalition to help clear out the Strait of Hormuz. That seems to be moving very slowly now. So definitely investors need to be wary of headline risk and volatility ahead.
And that's the thing, too, right? Like, for as long as this conflict continues in the Middle East and we see oil prices trending upwards, the trickle-down effect into the economy. Obviously, we're here in Canada seeing gas prices rising, but how else does this kind of affect different sectors within the economy?
Well, again, one of the themes in the last couple of years is that the top 20% of consumers in the United States is really doing a lot of the effort in terms of the spending and so forth. They benefited from a strong housing, relatively strong housing market, definitely a strong stock market, while the bottom sectors of the economy are being squeezed. Unfortunately, those are the people where the cost to fill up their car is a much bigger portion of their family spending. Those are the people where food prices are a much bigger and portion of their spending. Of course, food prices are definitely going to be going up because they have to move from point A to point B, and that takes fuel. Of course, diesel's practically doubled here since the start of the year. Having said that, of course, that upper strata of the consumers do have much greater purchasing power, and that seems to be keeping companies like Delta very optimistic.
Mm-hmm. Okay, so let's move on. There are a couple other things we're watching for this week, including an announcement that actually came out today. NVIDIA announcing that partnership with Uber and Lyft. This is a big partnership, big announcement. Do you think investors should be investing in these companies now that we're seeing them kind of link up?
Well, so I would be cautious there because when you look at the details, you're not going to see the rollout of these so-called autonomous vehicles until 2027, 2028, 2030. And of course, as we just saw with the EV, electric vehicle rollout, there can be a lot of enthusiasm in the beginning, but then the details start to emerge, markets start to shift, subsidies go away, and it is pulled back. Certainly, everyone wants an autonomous vehicle, but there's a lot of jurisdictions around here that are scared to death as to what that might mean for safety on our roads, pedestrians, all that kind of good stuff. So I think as a result, I would be cautious about increasing commitments to those two companies based on this news alone. We do like Uber. It is number one in what they do, the ride-hailing business. And to the extent that the AV rollout is delayed, that means they just have more demand for their traditional ride-hailing business. Certainly between the two, it's interesting, NVIDIA is 30 times the size of Uber. So any news that affects the two of them is going to have more of an impact on Uber. And certainly we've seen them boost up a little bit more than NVIDIA this morning.
Mm-hmm. We're also watching for big announcements tomorrow from both the Bank of Canada and the Federal Reserve on another rate decision. What do you think is going to happen, particularly with the Fed? What decision do you think is going to come down the pipeline?
I think it's going to be kind of a no movement, kind of a nothing burger coming out of the Fed. I think part of their problem right now is there are so many moving pieces, it's hard to really discern the underlying trend. Obviously, they're hoping that inflation starts to move back to the 2% target. And recently, we did get some news that suggested that inflation at least wasn't getting worse. On the other hand, they do have to concern themselves with a potential wave of inflation due to the higher energy prices and food prices that will result. The key thing for them is, to what extent is that a permanent change in inflation or a temporary blip that, to use one of their favorite words, transitory. So I don't think you're going to see much at all. Of course, we just heard from Australia today, and they actually hiked rates. So I think that is giving kind of a hawkish tone to the announcements from the central banks this week. We have wanted more rate cuts. Unfortunately, because of the energy developments, Fed fund futures now are just forecasting one rate cut before the end of the year instead of two, which is kind of odd because, of course, Mr. Trump has just named a new Fed chief who presumably is going to be more dovish than the current one, Jerome Powell.
Mm-hmm. Okay, so before we wrap up here, you do have a couple of stock picks for us as well. I want to go through those. The first one is Molson Coors. You say the stock has hit a multi-year low, but with low debt. So what do you like about this company?
So, iconic brands there, of course, international exposure, South America, Canada, United States. The stock is trading at about 7 times earnings. You got to find a 4.6% dividend. But what's really interesting is they have now recently announced plans to buy back about $4 billion worth of their stock. The market cap is only in the range of about 7 to 8 billion. So that's a significant portion of the whole company. So when you look at the stock dividends being paid out and the percentage of shares being bought in, you have basically a double-digit return to investors coming forward here. Of course, they've been hit hard by the tariff situation. There are some concerns, of course, that people are imbibing less, but they too have their own initiatives to have alternatives to alcohol drinks and big cost-cutting initiatives. So I think Molson Coors is a buy here. I also see some insider buying at that institution as well.
And just lastly, Campbell's as well, another company that's seen some multi-year lows. But what do you like about this company?
It's almost the same story as Molson Coors. I don't think they're buying back quite as much stock, but they do have a very hefty dividend here. You've got iconic brands in both their snack division and, of course, their meals and beverages division. They, too, have developed some growth initiatives to kind of stabilize the erosion of their brands and also to cut costs. We think that if they don't get that chip righted quickly, you're going to see some activists come in or even some strategic investors wanting to take their brands and consolidate them in, and that would be good for investors today.
Okay, we will leave it there. David Dietz, Chief Investment Strategist at Dietz Wealth Management Group. Appreciate your time. Thanks so much for joining us.
Thank you.
Coming up, the Bank of Montreal is gearing up to expand south of the border with plans to open more than 130 new branches in California. We've got more on that right after the break. Stay with us. The Bank of Montreal unveiled its plan to expand in California, and it's expected to open more than 130 new branches in the Golden State and about 15 in Arizona. So for more, we're joined by Bloomberg intelligence analyst Paul Gulberg. It's good to have you join us today. This is really interesting news. I'm wondering, when you look back at BMO's history, how did we get here in terms of this bigger expansion into the U.S.?
I thank you for having me. I don't think it's necessarily an expansion from where we've been. Obviously, the big expansion was the Bank of the West acquisition several years ago. The growth wasn't as robust as many analysts and investors expected, so the bank made a pivot. In October, they made an announcement that they are selling 138 branches across a number of Midwestern states to First Citizens Bank. And at that time, also in October, they did announce that they're planning to open about 150 branches that are going to be California focused. So today's announcement is really a reflection of what they've been promising for the past several months.
Where does this rank BMO, do you think, in terms of like Canadian banks that do have a presence in the U.S.? Like I take your point, BMO already did, but expanding into the southern states and opening more branches.
I do believe it's not. It ranks them definitely just behind the TD in terms of the branch footprint. TD is very much focused on the northeast and southeastern states of the U.S. with more retail strategy, where BMO seems to be pivoting from more of a retail strategy as well to a more wealth management, higher affluent client strategy. That's why they're sort of moving to California from those Midwestern states, where they can have more growth and more potential cross-sales into wealth. And this would be larger, but somewhat similar to what RBC does with City National and maybe even CIBC does with a smaller footprint with their private banking in the U.S.
Did the bank say anything today in terms of like a timeline of this expansion and when these new branches could open?
Yeah, they did talk about 5 years. So this is, again, something they announced in October, 5-year plan. They plan to open 7 branches in 2026. The sale to the First Citizens is supposed to happen in the middle of the year. The bank is actually hosting their Investor Day next year, where they typically talk about their 5-year plans. So I think we'll hear a little bit more about the strategy and the potential path of branch openings in the U.S.
Okay, we will leave it there. That's Bloomberg's intelligence analyst, Paul Gulberg, joining us live. Appreciate your time. Thank you. Coming up, the ETF report is next. Stay with us. Welcome back. We've got our ETF report coming up in just moments. We're going to take a quick check, first of all, on the markets as we start this Tuesday morning. We'll take a look at the U.S. markets to start. Trading up a little bit this morning. It seems investors are feeling a bit of a renewed optimism as crude oil trims its advances that we've seen over the last couple of days. The price of oil seems to be easing ever so slightly, therefore investors feeling a little more optimistic. Also, as we wait for the Bank of Canada and the Federal Reserve to make their next rate decision tomorrow, it seems as though investors may be pricing that in a bit south of the border. If we take a look at the TSX, similar story there. Trading up by more than a percentage point to start the morning, probably on the backs of a lot of energy companies within the TSX. And we'll take a look at the price of oil. We did see it rebounding. As I mentioned, it's steadying ever so slightly now. It's up more than 2%, but we saw it rebounding after its first drop that we'd seen in almost a week yesterday. And of course, we're watching that conflict in the Middle East. That is affecting the price of oil. Obviously, Iran continuing to target some energy infrastructure in the Middle East, including the Shah gas field in the United Arab Emirates and an oil field in Iraq. And of course, the controlled Strait of Hormuz also affecting the price of oil today. So obviously watching that very closely. And we're also watching the price of gold. As always, it seems to be steadying. It's up by 0.3% at the moment as traders weigh inflation. Of course, as I mentioned, a day ahead of some key central bank rate decisions coming tomorrow. We're watching the price of gold as well, still up above 5,000. And if we take a look at the loonie as well, looking undervalued, it's down by 0.03% at the moment. This comes as oil, of course, is staying higher, even though it is steadying. And we'll take a look at the price of Bitcoin as well. It's down at the moment by 0.7%. Canada's inflation rate cooled more than expected this month, dropping to 1.8%. But economists expect this month's report is likely the dip before the spike. CTV's Annie Bergeron-Oliver has more in this report.
Since the war in Iran began in late February, the price of oil per barrel has skyrocketed, increasing between 40 and 50%. And economists say that could push inflation up as early as next month.
Certainly the war as it is right now is going to impact on inflation. So the inflation numbers are going to go up. Once the gas prices go up, that goes directly into inflation. There's no way around it.
In February, annual inflation dropped to 1.8%, but the war had barely started when the data was collected. One gasoline-dependent sector economists say could start to rise: food inflation.
If you look at fresh fruits and vegetables that are coming in by truck from the southern U.S. or from Central America, that transportation cost is roughly 10% of the retail price. And so we will see some upward pressure for those products in the month of March.
Fresh figs. That possibility is concerning to many small business owners like Hanan Alame, who owns a charcuterie business. Alame loves the creative process, but says she's worried since the cost of food and gas seems to just keep going up.
It's been extremely hard. Even like I opened up a year ago, from a year till now, things have skyrocketed. It's been double in price. So even like the meats, the cheeses, the fruits, even gas, because I do deliver as well.
So what is the Bank of Canada, whose object is to keep inflation at 2%, likely to do when it makes its next rate decision?
I think the Bank of Canada is going to, without any hesitation here, stand until they know more about how this is going to play on inflation.
Okay, and now it's time for the ETF report. Our next guest makes a case for an ETF in the fixed income space. Let's find out why. Joining us is Frank Ross, Senior Market Strategist at Angel Oak. It's good to have you join us. Thanks so much.
Good morning.
So let's start with that then. Why an ETF in the fixed income space?
So about 4 years ago, we realized there was a gap in the market. If investors wanted sophisticated asset classes, they'd have to go to a mutual fund or a hedge fund. There wasn't something they could access in an active ETF wrapper. And so we set about creating and converting several funds. We now have 5 across most major taxable fixed income categories to give them that access.
Okay, so let's go through some of the ETFs that you like. One of your funds is called Angel Oak Income ETF. The ticker symbol is CARY. Tell us about this fund.
So the carry income ETF identified a gap in most investors' portfolios. They had 40 to 60% in core or an investment grade corporate portfolio that tended to be 7 to 9 years of duration, moderate income, high credit quality. And then the last 15 years, the risk bucket, it shifted from high yield to illiquid alternatives, hedge funds, private credit, private equity. There was this gap in the middle where a total return strategy with a lower duration profile, specifically 0 to 5 years by mandate, was needed. And Carrie's done a great job of filling that gap. Every single month since inception, we've been able to distribute around 6% net of fees. And then every single year, we've been able to add 1 to 3% of price appreciation on top of that. And effectively, it's giving investors a total return strategy, but with a shorter duration profile in U.S. credit.
You also have an ETF called the Angel Oak Mortgage-Backed Securities ETF. Ticker symbol for that one is MBS. What do you like about that one?
First, the ticker symbol. We got very lucky with that name, having a mortgage-backed fund with the ticker MBS. That being said, there was also a gap in this market where most mortgage ETFs, they were passive or quasi-active, as I say. And what I mean is they were typically allocating to the agency space. They were controlling for coupon and duration, but they were missing a broad swath of the market. So our MBS ETF not only controls for coupon and duration, but it's also allocating to the non-agency space, which is a market that most investors seem to ignore, frankly. It's $1 trillion+ in size. And these are borrowers paying 7 to 9% on their mortgages, but they've been kind of left out of the conforming guidelines in the post-Dodd-Frank, post-GFC world. And so we say with agency mortgages, you're getting a nice spread above corporates right now, but with non-agency, you're actually getting a spread above agency. It's spread upon spread. So the MBS ETF gives investors all of those in a nice, neat, active ETF wrapper.
Okay, so we're also watching this week, obviously, the Fed announcing its rate decision tomorrow. You say you're constructive on interest rates. Why is that?
So we don't think the Fed's going to do anything at this point. And honestly, they'll probably continue to hold rates steady for the next several months, several meetings. At this point, we like buying at these levels. We went from under 4 to above 4.3. We're back down to 4.2 right now. And when that type of rate volatility happens in active management, it's giving us an opportunity to go out and buy things at a discount. So we appreciate the volatility that it's created, and we are buyers at this level.
How sensitive are ETFs, though, to, I take your point, you don't think there's going to be any rate cuts or rate hikes tomorrow, but if there were to be, how sensitive are ETFs to different rates?
So the MBS ETF's around a 5.5 to 6 year duration. Again, that is actively managed. And then the carry ETF is very active in the sense that that 0 to 5 range, we were as low as 2 several years ago when the Fed was finishing their rate hiking cycle. Today we're around 4.05 because we do think that the propensity for rates to go lower over the next 6 to 12 months is obviously higher than it is for them increasing.
Are you noticing rotations in and out of certain styles of ETFs at the moment?
You've definitely seen a flow outside of traditional high yield corporate credit, senior loan funds, CLO funds. That's due in part to the fact that the interest rate increasing trade, right, that floater trade has really come to an end. We do think the market was a little bit kind of unusual. They were a little bit late to respond to that. Those flows came later than we would have anticipated. But now you're seeing, institutional investors, ultra high net worth investors, they're starting to migrate more into that medium belly of the curve type duration, higher end credit quality ETFs.
Why is that?
Well, one, the fact that you can actually increase yield somewhat to dampen the volatility by buying a 2 to 4 year type duration product. Whereas within a floater, within a CLO strategy, what you end up having happen is the spread volatility is still there, but you're unable to mitigate that in times of credit stress with that interest rate sensitivity offsetting it.
Okay, interesting stuff. We will leave it there. Frank Ross, Senior Market Strategist at Angel Oak. Appreciate your time today. Thanks so much for joining us. Coming up, NVIDIA CEO Jensen Huang is predicting the company's AI processors will help generate $1 trillion US in sales through 2027. We've got more on that after the break. The Bank of Montreal plans to open more than 130 financial centers in California and about 15 in Arizona over the next 5 years. The bank is looking to expand its presence in the U.S. West after the sale of several branches across the nation last year. The lender says the expansion will create hundreds of jobs and enhance access to in-person and advice-led banking. White House economic advisor Kevin Hassett says oil tankers are starting to dribble through the Strait of Hormuz. In an interview with CNBC today, Hassett said Iran's actions to choke traffic through the shipping route have not hurt the U.S. economy. He added more oil reserves could be released if needed. Hassett reiterated Trump's previous claims, saying the war will be over in a matter of weeks, and the U.S. is ahead of schedule in its plan. NVIDIA CEO Jensen Huang is predicting the company's AI processors will help generate $1 trillion US in sales through 2027. Huang was speaking at NVIDIA's biggest annual event, where he also unveiled a variety of new products. Huang announced plans to push deeper into central processing units, and he also introduced new semiconductors and NVIDIA's plan to develop chips for data centers in outer space. And for more on NVIDIA's technology conference, we are joined by Bloomberg's intelligence analyst, Mandeep Singh. So Mandeep, I'm wondering, how significant is this $1 trillion figure that we heard the CEO announce?
Actually, it does help the visibility through 2027. So we saw Broadcom gave a $100 billion revenue number for 2027 when they reported earnings. And a lot of folks on the investment side were wondering, what kind of growth rate to expect from NVIDIA. And clearly, I think with this forecast, we know this year they'll likely grow 70%. And for 2027, we are talking about almost a 30% increase in their top line. So from that perspective, estimates should go up given what they've guided to.
A lot of big announcements coming from the CEO. And as you mentioned, a lot of growth expected over the next couple of months to a couple of years. Do you think investors are still receptive to all of these big announcements?
Well, so I think everyone expects some sort of a digestion period down the line. It's a question of when and not if. And now that, we have guide through 2027, it makes it clear that, hyperscalers will continue their CapEx spending for another year at least. And so from that perspective, this is a trend that is a secular trend. And, Jensen called out inferencing revenue really accelerating, which will show up in the numbers of hyperscalers when they report their fourth quarter results in a few weeks. So from that perspective, it is a positive. I mean, barring any macro concern, I think companies are leveraging AI more and more, and that should show up in the results of these hyperscaler vendors.
Yeah, and like as you mentioned, a lot of these hyperscalers spending a lot on AI, and that had investors a little worried at first when these big spending announcements came out. When it comes to NVIDIA, how much capital spending do they have planned?
Also, the good thing about NVIDIA's business model is they don't have to invest in CapEx, but they have, increased their commitments to their suppliers like TSMC and Micron. And latest quarter, they reported $95 billion in commitments to their suppliers. So that's just a function of NVIDIA making sure they have the supply. And, that makes it hard for someone like Google TPU, which has a very good chip, but it just can't find the supply from TSMC to ramp up. And so from that perspective, too, I think that $1 trillion revenue suggests NVIDIA has a lock-in terms of supply, at least for the next couple of years, at its most prominent suppliers.
Mm-hmm. Do you think there is still some concern about too much concentrated exposure to some of these hyperscalers?
I think that's a great point. So look, even for that $1 trillion number, they said 60% will come from hyperscalers. So the positive for that is the hyperscalers are not reliant on private capital as much as some of the neo clouds like CoreWeave and Nebius and all these smaller companies are. So from that perspective, they don't have to really look to the bond market to raise big sums of money. They still generate in a lot of the hyperscaler cases excess of $100 billion in free cash flow every year, so they can continue to fund their CapEx through their cash flow. But for others, they will have to go to the private markets, and we know those can change very quickly. So from that perspective too, that reliance on hyperscalers, I look at it as a positive, at least for the next couple of years.
Okay, and obviously, just before we wrap up, like another announcement from NVIDIA coming with partnerships with Uber and Lyft for autonomous vehicles. This is a big news for those two companies, also for NVIDIA as well. We're seeing NVIDIA, you have more and more partnerships. Do you expect that to continue as well?
I mean, that's the one thing you're seeing with NVIDIA is expansion of their ecosystem. They're just not content with being a chip provider. They're moving up the stack. That's what they have done with their co-design. And with these partnerships, they have expanded their addressable market into other areas like robotics and autonomous vehicles.
So interesting. Okay, Bloomberg's intelligence analyst Mandeep Singh joining us live. Mandeep, really appreciate your time. Thank you.
Yep.
Coming up, Hot Picks, we will zero in on 3 plays in the semiconductor sector right after this. Stay with us. Data from Statistics Canada shows alcohol sales have been slowing. St. Patrick's Day will stand to test restaurants as broader shifts toward drinking less start to weigh on alcohol sales. And for more, we were joined earlier by Kelly Higginson, president of Restaurants Canada.
The decline over the last 4 years. And what I would say with that is that it's happening at the same time as we've seen a dramatic increase in our input costs over the last 5 years. So we've continually see a drop. At this point, we've got 21.1% of total revenues in 2013 were related to alcohol sales, but that number has dropped down to 17.1 in 2023, which is the latest available data. So that's a pretty considerable drop in the last 3 to 4 years. I think, we're seeing it per person at table service restaurants, a decline from $1,100 per person in 2019 to about $1,000 in 2025 when adjusted for population growth and inflation.
Kelly, you've given us the percentage of alcohol, but in terms of, can you just narrow it down to sort of a per revenue, like a per customer amount? And then also, if you would, what's the next highest margin item on a typical restaurant? Because I know alcohol is the highest margin, but what's the next sort of step and what can they promote?
So this is where we've got the challenges of the spending at table service restaurants. It declined from $1,170 per person in 2019 to $1,050 in 2025. So that is a pretty significant drop. And as to your point, what we've also seen is our, highest cost part is really in food costs and our margins in food costs. So, when we look at the increase in the cost of food over the last number of years, and that's really challenging our operators, the categories in order to find profit has become less and less available to our operators.
And this drop, is it solely by price because of cost? People just don't have the money to spend on that, or is it also they're just not drinking as much? And is it across the board, like from a smaller restaurant up to the high-end restaurants?
So it's a real mix. To your point, we've got 74% of Gen X who are stating that they're reducing alcohol for health and wellness concerns. But 44% of Generation Z are reducing alcohol because they are trying to save money. And the millennials right there in the middle with 51% are reducing alcohol for social and lifestyle cost reasons. So, we've definitely got a mix of all the reasons there. But, the reality is we've got a younger portion of Canadians aged 18 to 22 reported not drinking any alcoholic beverages in the past 7 days, which is a real switch compared to 54% for Canadians overall. So that next generation of consumers are drinking considerably less.
Wow.
Kelly, do you think there's any chance of stabilization here? I always get the situation that maybe one of the parts, and you mentioned it, is cyclical, but in terms of sort of getting down to a level where restaurants can actually sort of say, okay, that's the bottom, is there any chance of that?
I think we're actually, and look, I mean, this is all a guess, but to your point, I think we often see the pendulum swing in directions as far as trends. And, obviously we do have a chronic affordability issue, which that doesn't seem to be going away. But as far as kind of the lifestyle trends, we tend to see those pendulums swing pretty rapidly. And I do see it maybe starting to come back a little bit. But I also think as we talk to operators that we have to meet the consumer where they're at. So let's look at different ways that we might be able to. Is it serving lower alcohol level drinks? So some people are talking about still enjoying cocktails, but they're doing it maybe once a week. They're doing it less often, and they'll spend a little bit more for something that's higher quality but lower alcohol levels. Can we look at more operators? There was a period where we were increasing our ounces and glasses of wine up to 8 and 9 ounces for the large size. Maybe we need to look at having more serving those 3 and 4 ounces, something to sip on while you're having your actual meal. Those are going to be areas that we're going to have to explore. And I think there's definitely a lot of room for operators to explore the non-alcoholic beverage category. There's a lot of different ways we can have exciting cocktails that have no alcohol in them. But there's also some great products coming out on the market, beer, wine, and lower alcohol and no alcohol spirits.
And I think that may be challenging with the price too, because I've gone to restaurants and they have those mocktails. I know they don't call them mocktails anymore, but I mean, some of them are almost the same price or not much lower than a drink with alcohol in it. And I think you look and go, well, that's a lot of money to spend just for something that doesn't have alcohol in it. I just want to go back to, I mentioned about, is it across the board when it comes to restaurants, high end, low end? Is there a bit of a K-shape with the restaurants like we're seeing in the economy where the higher end people are still spending on alcohol and higher end alcohol, whereas when you get down to the lower end, they're holding back?
Yes, I mean where we've seen the biggest drop really is in the category of bars and nightclubs. They've seen the biggest drop over the last number of years. And again, this goes to when you're talking about the higher end. Definitely, we're still seeing the purchases, but we're seeing it. They're spending more on a higher quality of a bottle of wine as opposed to the volume of wine. So this goes to really consumers looking for that experience, and they'll spend a little bit extra to have a really good cocktail as opposed to having maybe 3 mediocre cocktails. And then again with the wine and other specialty items.
All right, and we're out of time. I just want to ask one more question. It's St. Patrick's Day. What are we expecting for today?
You know what? I'm cautiously optimistic, but I think, if I think back to the days of the lineup starting outside of some of our favorite Irish pubs early in the morning for people to get a seat, I think it's fair to say that those days have come and gone. So, hopefully we see people get out and enjoy their local restaurants, because it's definitely a challenging period for all of us.
Okay, it's time now for Hot Picks. Today, we are zeroing in on 3 plays in the semiconductor sector. Our next guest has NVIDIA as his top pick, arguing the stock is still undervalued even as it delivers quarter after quarter. So for more, I'm joined by Matt Bryson, Managing Director covering semiconductor and hardware research at Wedbush. It's good to have you join us. Thanks so much.
Thank you so much for having me.
So you think NVIDIA is still undervalued? Why is that?
The company keeps on performing. It's trading at less than 20 times my 2027 fiscal 28 estimates, and they're growing at, I think, 60% this year in terms of top line. I think they are still the leader in AI. I think AI is changing the world, and I just don't think there's anything that's going to stop them the next couple of years.
So some big announcements coming out today from the CEO of NVIDIA, or yesterday, I should say. Do you think all this spending that we're seeing from the hyperscalers, including NVIDIA, you're not worried about investors being a little concerned about that excessive spending?
Oh, I think certainly that's one of the concerns that's weighing on the stock. I think that there are some concerns around competition. But when you look at what's happening at their customers, and you listen to what they're saying, where they're telling you they're not demand constrained at this point. They are supply constrained. You talk to some of their peers, and they have the same problem. It's you can't get enough wafer starts at TSM. You can't get enough memory from the memory players. That's actually holding back revenue as opposed to end demand. And from a supply chain perspective, that's how things look through 2027. So it feels like the smartest guys out there, the Microsofts, the Googles of the world, are continuing to lift their spend. And I think the smartest guys are telling you that they're betting more on AI, that we're not going to see spending fall off anytime soon.
Do you think there's a timeline, though, in terms of seeing return on investment for investors, like in terms of investors' patience wearing out?
I think that you have to show an ROI, but at the same time, if AI is going to change the world, and to some extent, we were not necessarily seeing that last year, right? It was still, last year was all about training models for most of the year until you got to the end of 25, and all of a sudden inference workloads started taking off. And if you're effectively doing the job of what used to be humans, you're creating value. And so I think we're finally seeing value creation show up.
Okay, we'll move on to your next hot pick. This one's Micron Technology. What is it you like about Micron?
So memory is really, really tight. It comes back to how much is getting spent on AI. You need a lot of DRAM to support these data center build-outs. You need a lot of storage to support these AI workloads, and there just is not enough capital. There isn't enough production right now, and so we're seeing unprecedented increases in memory pricing. And when you look at Micron, I don't think those price increases are fully baked into estimates. And so you have a company that's is trading at roughly 5 times my out-year numbers. And if anything, I think my numbers are too conservative given what we're seeing in price shifts in the calendar Q1, calendar Q2 timeframe.
Okay, last pick is Everpure. What do you like about Everpure?
Yeah, so Everpure, they make a storage system. They're dealing with the same problem that all the OEMs are. Costs are going up. The thing that they've figured out how to, or the way that their system works, they simply use less memory than everyone else. So they're using 20 to 30% less NAND per usable block of storage than all of their peers. So when everyone's costs go up, theirs go up less. At the same time, everyone on the storage array side is raising pricing. So you have system prices already having lifted 20 to 30%. If we're going to see prices lift again, and I think we are, it becomes really easy to hit growth numbers that are in the teens when your pricing's going to go up that much.
It's interesting they have such an advantage over their competitors, as you just mentioned. Like, where does that come from?
It's just the way they structured their system initially. They've always had higher gross margins than the rest of the industry, and it's always been an advantage for them. It's just we haven't seen this type of cost acceleration before, so they haven't been able to take advantage of it in the way that I think they're going to take advantage of it this year.
Okay, so interesting. We'll have to watch for that. Matt Bryson, Managing Director covering semiconductor and hardware research at Wedbush. Appreciate your time today. Thank you.
Thanks.
Up next, will surging energy prices influence tomorrow's Bank of Canada decision? That's just ahead. Stay with us. The Bank of Canada is expected to keep its benchmark interest rate unchanged as it tries to gauge the economic impact from the war in the Middle East and the spike in energy prices. For more, we're joined by Bloomberg's Eric Hertzberg in Ottawa. So, Eric, I guess good to see you. Safe to say that the bank will maybe stand pat this time around?
Yeah, we'll jump to the conclusion first. They're going to hold at 225. So they've been there for the last that would be their third decision that the Bank of Canada has held rates at that level. And recall in the last decision in January, they continued to say that they believe that interest rates were at about the right level to help the economy transition and deal with the structural changes that are being caused by the tariff war with the United States. That's hit exports pretty hard in other parts of business investment as well. But they also said that rates are at the right spot to also keep inflation in check. Now, what's changed is obviously the oil price shock that's happened. In January, the Bank of Canada had based their monetary policy report and their inflation and growth forecasts on a level of Brent at about, that's the Brent benchmark for oil, at around $60 a barrel. Today it's trading at $102 a barrel. So clearly all their forecasts are now stale. We don't get any forecasts for inflation and growth that are normally offered on those monetary policy reports. The next one is in April. So most economists that we speak with expect the Bank of Canada to not give too much clear guidance on the way they're thinking about any changes to their stance at this point either. So the way it looks right now is rates are on hold and with possibly some sort of reference to the inflation risk that is posed by the higher oil prices.
Yeah, I mean, that's what I was going to ask you. There's usually some references in there, also some references to things maybe the Bank of Canada is watching for over the next couple of months that could change their decision moving forward. A couple of these factors, obviously the GST tax break, we saw that affecting CPI numbers in February, that tax break from last year. So how would a factor like that maybe affect the economy and inflation moving forward?
Yeah, well, we could see that in the data now. Actually, the data that was released yesterday morning, the inflation data shows that that headline inflation is actually below the bank's 2% target at this point. And that's after a lot of the effect of the tax break that was in the data from the previous year started to roll out. So you can start to see that we're actually, in terms of inflation, in a good spot, but that's ahead of what's going on with this spike in oil prices that's happened recently. Now, the thing for the bank is the last year has been uncertainty has been the word of all of these central bankers. There's so much uncertainty out there in terms of what the tariff war was doing to hit the economies and inflation, and that all still persists to this point. But now we have this added risk, which is the conflict in the Middle East and the war in Iran, that's adding a great deal of uncertainty to oil prices. Now we see, as I mentioned, Brent's trading around 102, but how long is that going to sustain at that elevated level? That's yet to be seen. But you can be sure that in Canada, if we have oil prices elevated for a long period of time, the net effect is probably going to be inflationary.
Yeah. Okay, that is Bloomberg's Eric Hertzberg in Ottawa joining us live. Eric, really good to get your insight. Thanks so much for your time. And that wraps up this edition of The Open. Morning Markets with Roger Peterson is next. Stay with us.